I really want to apologize for the name of the company in this question. It's Mission Burrito. It's named after the Mission neighborhood in San Francisco, and they made amazing burritos. Now, there was a ton of different burrito places. This is just a generic name, but really what comes to mind is a big, thick burrito. Maybe it's chicken or pork or steak, but either way, so tasty. So do yourself a favor, knock out variances, and then go get yourself a burrito. Now, if we skip to the last sentence, we need to figure out what is the debit or credit to the direct material efficiency variance account for the year. Well, we're focused on direct material variances. Both the efficiency and rate variance we'll need to assess to come up with the full journal entry. Now, we wouldn't necessarily need to do that if we just wanted to figure out the efficiency variance, but guess what? We like to figure out the big picture. So what we'll have to do first is go through and calculate the direct material efficiency variance as well as the rate variance, and then we'll come up with the journal entry. So starting with the efficiency variance, well, we're focused on did we use more or less materials than we had budgeted. Well, they actually used 4,000 pounds. They had budgeted 6,000 pounds. So that means they used 2,000 pounds less. We multiply by the standard or budgeted rate per pound of $5, and that's a direct material efficiency variance of 10,000. Now, this is actually going to be favorable because they used less than they had budgeted. So this is good, right? So we'll consider what that 10,000 impact looks like in the journal entry after we focus on the direct material rate variance. So the direct material rate variance, which we also call the price variance, well, in this case, we're focused on the price. So the actual cost per pound was $8, and the budgeted cost was $5 per pound. So unfortunately, they ended up paying more. We don't know why. Maybe just the cost of raw materials went up. But that's unfavorable because the actual cost was higher on a per pound basis. $3 higher to be exact. And then we multiply by the actual quantity that was purchased and used, which was 4,000 pounds. So that results in a direct material price variance of 12,000. And that is unfavorable, again, because the actual cost was higher. So now we know that the actual direct material rate variance was 12,000, and then the direct material efficiency variance was 10,000. So let's build out the full journal entry. So when it comes to recording the purchase of raw materials and capitalizing it into inventory, well, under standard costing, we do it at the standards, right, which would have been 6,000 pounds times $5 per pound. So we'll have a debit to inventory raw materials for 30,000. Now for the variance that was unfavorable, that's going to be a debit here, and that's for the direct material price variance. Remember, that was 12,000. So we'll have a debit to the direct materials price variance for 12,000. That's going to increase inventory as well, because remember, we had an actual cost that was higher than the budgeted. Now we were more efficient, meaning we purchased and used less, and that's where the direct material efficiency variance comes in. Now, since that was favorable, that's going to be a credit for 10,000. So if we look at these three accounts together, well, it nets out to the total impact to inventory of $32,000. And what's the offset there? Well, that's what we actually purchased at cost. And we have to pay our suppliers or vendors, which will be done in a subsequent period, right? But for now, we'll just credit accounts payable for $32,000. So basically, the total impact to inventory when we net out these three accounts would be an increase with a debit, net debit, for $32,000, and then we're paying our suppliers or vendors $32,000, and that's why we record it to accounts payable. Now, ultimately, the option here, right, that best describes what the question is looking for, which was the debit or credit to the direct material efficiency variance. Well, that's going to be a credit to the direct material efficiency variance for $10,000, so that's the correct answer. Now, like I've said previously, I love this types of question because it not only focuses on just what the variances that the question is asking about, but it requires us to understand the bigger picture and the two variances that impact direct materials, and then also looking at the journal entry as we see this all the way through to how it impacts the company's financial statements.